Hi, welcome to today's podcast and this section of the Millionaire series. Now, today's focus is don't buy a home, buy stocks. The way to become wealthy extremely quick is to invest in assets that accumulate quickly. So, as you've heard in previous podcasts that I discuss, poor and broke people typically invest in depreciating assets like cars that lose value over time, or clothing, or other things that you could buy, maybe a snowblower, maybe a snowmobile, maybe a jet ski. These things all lose value over time. Wealthy people, whether they have $1 million or $5, invest in things that gain value over time. Now, when people realize this, typically in their late 20s to mid 30s, the first thing they think of is, I need to buy a house, because essentially I'm throwing rent away and giving it to somebody else. Maybe it's $1,000 or $2,000 or $4,000 or $6,000 or $8,000 a month you're paying in rent. Now, if you were just putting that towards a mortgage, you'd be actually building equity, right? Wrong. With the way that most mortgages are set up these days, especially in higher cost of living locations around the United States, you might get yourself into a 30-year ARM, 7-year adjustable rate mortgage loan. Typically what the bank is going to give you is a jumbo package, or the largest loan package that you qualify for. Whether you're subprime or 700 or close to 800 credit score, the bank's always going to try to prey on you. They're going to give you the highest interest rate that you'll accept for the longest term that you'll accept. The reason this isn't good is, say you have a 4.5% interest rate on a 30-year loan. Over the life of that loan, you're going to pay a considerable amount of interest. Now, the problem with the way that mortgages are set up, you don't actually pay money towards the principal of your home until later on. So the longer the term of your home loan, the longer it is until you actually start building up equity in your home. Now, this is a real issue. If you're paying $4,000 a month towards a mortgage, or even $250 a month towards your mortgage, the psychological effect is that I'm building up equity, I'm building up ownership in something. The reality is the bank owns your home. You don't own anything unless you're building money on your principal. So this is why I firmly believe in renting, not buying a home as your first major investment. Think about this for a second. If you were to put $50,000 into a down payment for a home, and then every month pay $2,000 towards your mortgage, and you did that for 30 years, from age 30 until age 60, and it's time to retire. Let's just do the math really quickly. If you were supposed to put 20% down, 5 times 50,000, really basic math, says you just bought a $250,000 home, and it took you 30 years to get there and a lot of interest. Now, let's do another calculation. Let's say you had put that $50,000 into the stock market, and your monthly addition to this principal was $2,000 after tax take-home pay. So $2,000 a month. Well, simple math there. 2,000 times 12. That's 24 grand. So $50,000 principal balance plus an additional $24,000 a year into an investment. And I think you know where I'm going. Investing into the stock market. And we'll get to the topic of the risk. 30 years to grow, 30-year mortgage. And let's just be conservative and say that we're going to track the S&P 500, which over the history of time has proven to pay out anywhere between 6 and 10% on an annual basis, averaged over time. So let's just say 8%. And we're going to calculate that. Okay. When you turn 60, you could either own a home that's worth $250,000, paid in full, and that can be your retirement nest egg. And I'm sure it will have appreciated over time due to the economy and inflation 2% a year. So it's going to be worth a little bit more than that. Best case scenario, worth $500,000 or $600,000. The future value of your investment, if you would put that same money into the S&P 500, $3.4 million. Okay, that is the single reason why you should not buy a home and you should invest in the stock market. Thank you.